This has been the largest rally of any bear market going back to 1932. What does that mean for you and your money? That's coming up on 3 Minutes on Markets and Money. Going back to 1932, looking at bear market rallies, the current rally, which is almost 10% now, is one of the largest that we've seen throughout history. Now, this is assuming, of course, that we're in a bear market, but here's the interesting thing. While technically the S&P did not get into a bear market during this decline, we were only down about 12% at the lows. The action of the market is very similar to what we see during bear markets. In other words, it is only during bear markets that you see these types of very strong reflexive rallies throughout history. So what is this a function of, right? We've talked about that we had at these lows very negative sentiment. We had very light investor positioning at this point. A lot of people have gotten very short the markets. Speculators had pretty much evaporated. We talked about the AARK funds, right? Down almost 30-40% for the year. Lots of damage being done in the market. So underneath the surface of the market, there was certainly a bear market ensuing across a lot of asset classes and across a lot of stocks. The subsequent rally here, and we started talking about that we would get a reflexive rally from these lows because all we needed was a little bit of good news, right? So we started to see a little bit better news. The Federal Reserve talking about hiking rates, not doing a taper just yet, really didn't surprise the market at all. Also, just recently here, seeing some light potentially at the end of the tunnel for the Russia-Ukraine conflict as well. That's led to this reflexive rally now over the course of the last couple of weeks. And that type of action is mostly driven by short covering. Markets are now back to extremely overbought levels on virtually every measure, and volume has been weakening across this entire rally, and particularly over the last few days. We've seen a very sharp drop in the volume of stock actually traded. So a lot of speculative action, a lot of reflexive recovery in very beaten up stocks, potentially driven by short covering, as shorts have to cover their positions. That potentially has a very limited life. So a couple of important aspects here to pay attention to. First of all, the market has now recovered from being 2 standard deviations oversold to 2 standard deviations overbought of the 50-day moving average. Now, according to physics, if I stretch a rubber band as far as I can in one direction and let it go, the rubber band on the first reflex will travel an equal distance in the opposite direction. Exactly what you see here in the markets, an exactly perfect reflexive response to the very oversold condition that we saw previously. Now, importantly, markets have the ability to potentially challenge all-time highs. Now, if that would occur, again, a bit more of an upside drag from here. But if we do challenge all-time highs, it still doesn't change the dynamics of the markets being in a giant consolidation range going all the way back to the highs of December. Haven't really changed the dynamics of anything in terms of the market. And a rally to all-time highs doesn't change the correctional process that markets are in. But now we'll be back to extremely overbought conditions as we head into a Fed tightening cycle, slower economic growth, and again, the risk of a recession advancing a little bit faster than probably a lot of the economic data currently suggests. Certainly risk to the downside, as we've been talking about here recently. Use this rally to reduce risk in your portfolio, trim off losers and laggards, rebalance your long-term holds, and look at adding some contra holds as well to potentially shield you from a decline. Again, as we've talked about lately, long bonds, as opposed to stocks, which are extremely overbought, long bonds are extremely oversold here and have actually been improving in performance over the last few days. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.